All right, welcome to this explainer. I am absolutely pumped to share today's breakdown with you all. We're going to completely demystify a repeatable, highly effective, and honestly surprisingly simple three-step system. It's called the Quick Flip Scalper. This whole strategy is about taking morning market volatility, which, let's face it, scares a lot of people away, and turning it into your absolute biggest advantage. Let's get right into how you can conquer the first 90 minutes of the trading day. So, here's our roadmap for today. We're going to cover the 90-minute window, then walk through step 1, boxing the range, step 2, confirming the manipulation, and step 3, spotting the reversal. Then, we'll tie the whole shebang together with a live NVIDIA trade. But first, I got to ask you a painful yet totally relatable question. Why do your stop losses always seem to get hit right before the price reverses and goes exactly where you originally thought it would? Seriously, it feels personal, doesn't it? It feels like this rigged David versus Goliath battle where retail traders are just getting crushed by massive institutions. Well, as you're going to see, it's not paranoia. It's actually by design. This quote right here brilliantly illustrates the harsh reality behind those stopped-out trades. Old-school trader Dr. David Paul points out that massive financial institutions, well, they can't just smash a buy button for huge orders without totally wrecking the price. There simply isn't enough liquidity for them. So what do? They engineer a situation where 100,000 guys like you have your stop losses hit. That triggers a sea of liquidity, basically turning retail traders into a massive pool to fill their institutional orders. Literally, they are hunting your stops on purpose. Okay, let's dive into our first major concept, the 90-minute window, which is exactly where the real money changes hands. If you've been around the block, you know this 90-minute window is an absolute bread and butter time frame. The vast majority of profits are made right at the open. But to conquer it, we have to understand the core mechanism at play here, which is the liquidity candle. Basically, a liquidity candle is a super fast, aggressive price movement right at the open. And actually, the direction doesn't even matter. It's a pure emotional trap. When newer retail traders see this crazy aggressive move, FOMO kicks in hard and they chase the momentum. This perfectly engineers that exact liquidity pool those big players need to fill their massive positions. So how do we flip the script and use their traps to our advantage? That brings us to step 1, box the range and set the 15-minute trap. This protocol does require some strict discipline, but it is beautifully simple. You just open up whatever asset you're trading on a 15-minute chart. The second the market opens, you do absolutely nothing. You sit on your hands, you grab a coffee, and you let that first 15-minute candle completely close. Once it's closed, you just take your drawing tool and connect the very highest wick to the very lowest wick, making a box. Then you just extend this box into the future for exactly 75 minutes. Why 75? Well, you add that to our first 15 minutes and boom, you've got our exact 90-minute trading window. All right, with our box drawn, we move right into step 2. Confirm the manipulation. And we do this by doing the institutional math. Our magic number here is 25%. We're going to use a super common indicator on the daily chart called the average true range, or ATR, usually just looking at the default 14 days. This basically tells us how much the asset normally moves in a full day, right? To confirm the manipulation, that single 15-minute opening candle we just boxed must equal at least 25% of the asset's entire daily ATR. Let's put that into perspective with a concrete example, using the NASDAQ. Say the daily average true range for the NASDAQ is 400 points. 25% of that is 100 points. Simple enough. Now, if that 15-minute candle we just boxed has a high to low range of 173 points, well, it absolutely crushes our 100-point requirement. And just like that, liquidity manipulation is mathematically confirmed. The trap is officially set. Which leads us to step 3, spot the reversal. Here's where we drop down to the 5-minute trigger. So the trap is set, meaning the price is primed to reverse. By dropping down to the 5-minute chart, we are now strictly hunting for one of 2 specific visual signals just outside of our box. Option A is a hammer or an inverted hammer. Those long wicks are dead giveaways that massive buying power just stepped in to reject the price. Option B is an engulfing candle, which is where a large, aggressive candle completely swallows up the previous smaller one. If either of these patterns pops up outside our box within that 90-minute window, that is our green light to get into the trade. Okay, before we jump into a live chart, let's do a super quick mental reset on this quick flip blueprint. Step 1, box the 15-minute opening range. Step 2, confirm it's greater than 25% of the average true range. Step 3, drop to a 5-minute chart and spot that reversal candle outside the box. It's crucial to remember if any of these steps are missing, or, and this is incredibly important, if that 90 minutes expires, we just walk away. We do not take the trade. Theory is great and all, but application is everything. let's actually put this blueprint into practice with a live NVIDIA example. So heading into the market open, we do our institutional math. NVIDIA's daily average true range was $8. That means our 25% target threshold is $2. The opening bell rings, and that first 15-minute candle is just wild. It pushes way down and closes with a total size of roughly $5. That obviously smashes our $2 threshold. The result? We've got a massively confirmed liquidity manipulation candle right on our hands. Now, we literally draw our box. The low wick of that opening candle was down at $176, and the high was at $182. We extend this box to the right for 75 minutes. Next up, switch down to the 5-minute chart. And guys, here is exactly where discipline separates the pros from the amateurs. Because that opening liquidity candle was negative, we have to wait patiently for the price to break completely below our $176 floor to search for a bullish reversal. We don't guess, we just wait. And then, bam, the trap is sprung. The price drops below 176. A strong red 5-minute candle pushes lower. But wait, it is immediately followed by a massive green candle pushing right back up. We have a textbook bullish engulfing pattern formed entirely outside and below our boxed range. This is the ultimate signal that the big institutions are fiercely buying up the exact dip they just engineered. All right, let's break down the exact execution parameters of this trade. We set our entry limit order right at the high of that previous red candle, which is $175.15. The stop loss, that goes safely tucked below the newly formed bottom at $172.50. And for our target profit, we're simply aiming for the very top of our original 15-minute box, sitting pretty at $182.30. Setting it up this way gives us an incredibly satisfying risk-to-reward ratio of 1 to 2.7. Now, once we're triggered in, the trade does need some active management. As the price pushes back up and re-enters our original 15-minute box, we manually slide our stop loss up to our entry point near $176. This is absolutely crucial because it perfectly protects our capital and secures a break-even worst-case scenario. From there, we just let our edge play out. And in this specific example, the price marched steadily upward, successfully hitting our target profit at the top of the box at 1:45 p.m. Just a beautifully executed, highly structured trade. Now, as always in these explainers, we've got to stay grounded in reality for a second. While this specific strategy has literally decades of proven history and relies on core market mechanics, you know the drill, historic results never guarantee future returns. The markets are always shifting. You absolutely must evaluate your edges regularly, apply strict risk management, and realize that some strategies just work better in certain asset classes than others. Which really brings us to our final thought for today's explainer. We've decoded the emotional traps, we've boxed the range, and we've done the institutional math. Honestly, the only thing left to ask is this. Are you ready to stop being the engineered liquidity pool and start actually trading alongside the institutions? Armed with this clear 3-step blueprint, tomorrow morning's opening bell might just look completely different to you. Thanks so much for joining me on this deep dive. Stay focused and keep learning.